Hello, everybody out there. How are you all doing? I'm Kate Hill, and I am here as always to give you honest, unbiased, and the best commentary about our property markets, along with fantastic hints and tips. And today, I thought it was about time for a special guest. So I have Tina Howes with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We're going to update you on what is happening in the finance world. We are talking about whether you need a pre-approval, the bank's processing and turnaround times, and what to do if you want to build your property portfolio. So stay tuned. Hello, everyone. So as I mentioned, I have Tina with me today from SmartMove. Tina, hello.
Hi, Kate.
Hello. We're all still in lockdown, so you've got us in various guises, as I mentioned in my video last time, you know, the husband hairdressing and various other things. You're just going to have to take us as we come. But I thought it was time that Tina and I thought it was time that we had a chat about what the banks are doing. So Tina, tell us how you are, and then tell us what the banks are up. Tell us what the banks are up to as well.
Okay, all right. So it's a little bit deja vu, the whole lockdown and COVID from last year. I thought we got through it, but here we are again.
Here we are.
It's been really, really interesting seeing the bank's reactions this time around.
Yeah.
If I sort of backtrack a little bit to last year, it was a bit of a freak out. Nobody knew what was going to happen. The banks didn't necessarily have the capability for every single staff member to work from home and work remotely.
Yeah.
So that has been a huge change this time. It's fair to say the transition has been pretty smooth. We haven't seen the same blowout in turnaround times like we did last time. And we haven't seen the same kind of knee-jerk reactions from a credit perspective either.
Yeah.
So I guess from our perspective, it's very much business as usual. Obviously, if you're in an industry that's impacted by COVID, then that's not going to change the bank's viewpoint from a risk perspective.
But you mean sort of typically like a tourist worker, an event or hospitality worker, when you say...
Sorry, I'd probably phrase that incorrectly.
Yeah. No. Sorry.
From a bank's perspective, every application is looked at from a risk perspective. And are you good proposition for us to lend money to?
Yeah.
Are you going to keep making your repayments, and will we get our money back ultimately? So the fundamentals of lending is still going to be the same. So if you happen to work for Qantas or work in tourism, then those questions will get asked and they have to be addressed. It's as simple as that. And it may be that from your perspective, if your job's not certain, then it's not the right time to get a mortgage. Or if you've been, stood down and on reduced income, perhaps you can't borrow as much as you would like to, and maybe now's not the right time until things reopen. So that's kind of my world. It's still super busy. The property market is still going gangbusters. People are still wanting to buy properties, sick of paying rents, attracted to the lower interest rates, and attracted to seeing their bank balances go up month on month because there's not so much to spend it on.
No, that's right. I'm interested though in what you said about the turnaround times, because my experience is a little bit different. Maybe that's just luck of the draw, but I've had a few sort of clients recently where it's come down to the wire, really, in terms of, you just barely scraping it in there within whatever finance clause you might have, depending on what date you're buying.
To touch on that a bit more, when I say that the bank's turnaround times weren't impacted by this current lockdown, yes, turnaround times have been blown out and protracted for the last couple of years, but it hasn't just all of a sudden got worse because now Sydney's in lockdown and Melbourne's in lockdown, right? So the time it takes to get an application through is still longer than it was 2 years ago. Yeah. So yes, absolutely. If you're wanting to buy a property, don't expect to go for that nice walk to the coffee shop on the weekend, see a property for sale, and then get a pre-approval and be able to buy it. It's certainly a case of get in early, and depending on your timeframes, that might dictate lenders. So yeah, it's definitely taking banks longer. And you know, one bank, for instance, was taking so long to get pre-approvals through that they essentially pulled out of doing pre-approvals or just did system-based or one touch. So we'll look at your application once and then we won't look at it again until you actually have contract of sale. So better get it right first time type thing. Those banks, you know, it might have been 4 weeks or 5 weeks, have come back down to sort of 2 weeks. But even for some banks, though, we're seeing bottlenecks at the certification stage where documents come back and it's taking them 4 weeks to look at those documents and check and make sure that they're all in order and booking a settlement.
And I think, and I would like to come back to that again shortly, but I think that's a really important, it's a really important issue, whatever, thing for everyone to note. Pre-approvals, so to get them or not to get them, that is the question. You know, does it depend on the bank? Does it depend on you, as in the borrower? What are you, what shall the lovely people do, Tina, apart from see you?
Look, historically it was always a case of get a pre-approval, and that was all very well when you could get a pre-approval pretty quickly. It's now come to a point where there are so many banks that are not doing a pre-approval or are simply doing a system of pre-approval, which pretty much means that it's numbers in, check them off, and system generates an outcome with a credit check.
So to put that, it's kind of into context, sort of, so someone will come and have a chat with you. Let's say I say to you, Tina, hey, I want to buy property. You check me and my financials out, you run me through the system, and it would then in theory spit out yeah or yay or no.
Probably more so, Kate, you'd come and chat to me, I would receive absolutely every single document under the sun, verify it, get a credit check done. There's no system as such. It's more when we look at the lenders available to you that are going to give you the best outcome, meet your needs, most competitive, so forth, depending on what your requirements and objectives are. It's a case of, okay, well, this bank, really sharp rate. However, the pre-approval that they're going to provide us with is actually only a system-based pre-approval and won't be looked at by credit until such time as you've actually found a property, got a contract of sale and so forth. So the advice that I provide is case by case, depending on the client. If it's a very, very vanilla situation, you know, 2 applicants, PAYG, it's very much a formula where it may be that lender is giving the best rate and can give us that system-based pre-approval within 24, 48 hours. That might be adequate for that client. Then you may have another client on the spectrum that it doesn't meet credit policy. It requires credit to make an exception. There may only be 1 or 2 banks that can help that client in those circumstances, which puts them at a risk if perhaps we go for formal and evaluation comes in short. In those circumstances, it may be a case of we really need to go to a bank that's going to have a credit person look at it and issue you with a pre-approval that is credit-based. So it's really case by case, and it's steering a lot of clients to certain lenders that will issue pre-approvals that are credit assessed versus lenders that aren't. But as I say, there are many a client that I could get them financed from multiple lenders any day of the week, but it doesn't matter. And so if they're coming to me saying, we found our dream property, then do I need to wait for pre-approval, or it's, well, let's do the numbers, do the due diligence, do a credit check, got every I, cross every T, and on that basis, are you in a position to potentially go and buy that property?
Yeah.
You know, it's potentially 50% of clients that are doing that at the moment. And for many a client, it's a perfectly reasonable situation.
Yeah. Okay. Well, that sort of very nicely brings me on to, I guess, a question that I would have, and I think something that I get asked a lot, and that is, at what stage should people engage with you? You know, as you know, I'm a big fan of the broker rather than going straight to the bank, for all the reasons that you've beautifully just illustrated, but obviously many more. But I kind of think, especially at the moment, if you're getting purchase ready, it's critical to come and see you before you do anything, right? But talk us through, at what point ideally would you like to, you know, rather than just be, hey, I've just bought something, Tina, I need to
Look,
not me.
At the end of the day, most people will get finance if you come after you found your property. However, if you want to have the best experience, the best rate, the most suitable, appropriate lender, in a timely fashion, and be able to sleep at night for that settlement period, you ideally want to talk to your broker once you've started to have that thought of, I want to buy a property, I want to buy a home, or we want to buy and sell, or we want to buy an investment property. Okay, that's the time that you really want to start that conversation, because that's ideally when everything can be reviewed without that time pressure. And, you know, if you look at clients that have existing properties, they might not be structured appropriately. There may be requirements to restructure, refinance, move one loan from home onto investment property, you name it, and you might be looking to extract equity. And those things can take time. So it could be, particularly for your clientele, Kate, where a lot of them, we've bought our property, we've got lots of equity, we want to start investing. The time to talk to me is not after you've gone and refinanced your home loan for the lowest rate you can find on Google. It's before all of that, so that there is adequate time to do everything properly.
Yes.
Because sometimes it involves multiple banks.
Absolutely. And I think, I do think that, as much as we love you all out there, people do underestimate what the preparation that they need to go through, and that they should go through, you know.
Absolutely.
What's involved here. Like you say, it's not just about Googling the lowest interest rate. People also underestimate, and I speak from personal experience, everyone, you'll know this, that, you know, structuring your loans and how you do it to future-proof your further investing, or just your, you know, life in the future, is critical. I think
it may involve a trip to your accountant, or if you haven't, say, let's say you haven't got an investment property, you may do your own tax, or, you know, it may involve a transition to a new accountant that can provide appropriate tax advice. And those things take time. You know, like any specialist, if you're going to try and ring someone, and if they're busy waiting for the phone to ring, there's probably a reason why. So if you want to get quality advice, there may be a little lag time
as well. Yes.
Your accountant, your solicitors, your buyer's agents, your finance, your mortgage broker, the bank, all of those things.
What about people who are looking to now, say they have their own home, or maybe they don't, they're rent vesting, but they have a property that they're either living in, or they've got an investment property. Let's say they have at least one investment property, and they're looking to build that portfolio. How are the banks dealing, you know, how are we dealing with the multi-property portfolio?
Yeah, absolutely. Look, that's bread and butter business to the banks. There's certainly no judgment or prejudice against investors out there. You know, we saw that, Kate, very, very closely several years ago, when it was almost a dirty word to buy an investment property, and interest-only loans, rates were hiked, all of that. Where it gets challenging is when you've got, you know, 3, 4, 5 properties plus, or particularly if you have a heavier reliance on rental income than you do from PAYG or self-employed income. Okay, there are banks that won't play in that space, but there are also plenty of banks that will.
And is that simply because they're seeing rental income as more risky?
Yeah, I guess so. There is some comfort in an alternate income stream from your going to work every day, and we've got low unemployment levels. The irony with that is, look at the low rental vacancy levels, and we don't see an abundance of stock coming on that's going to change that. So, having said that, obviously there are pockets out there, and you would know this, and more than likely haven't purchased in those areas. But there would be areas that have high rental vacancies.
Yeah, of course. Yes. Yeah, I've talked about it many times in the videos.
Yeah. And an abundance of high rises in the area, all coming onto the market at once, downward pressure on rentals.
Yeah, it sort of seems, from where I sit, I'm like, but that's not fair. When you've got property that is solidly rented, in good areas, year after year after year, that surely is actually a more reliable income than any job that you might have at the moment. To me, like I say, naively, I don't think like that, do I? But I'm like, it's not there. So what about, so again, it's just, in that case, multiple properties is just important to come and see, talk to the broker who knows the situation, who can assess what you may and may not be able to do.
And remember with that, it's always overlaying what the loan to value ratios are. So how much equity you have. And if you have a portfolio that's not as highly geared, then the bank's going to look at that more favourably. Because I guess, like anything, the lower the debt is as a percentage of the rental income, the more you're able to withstand a period of vacancy.
Yes. Okay. From my side, one final question. I personally know a lot of people who, let's say, over the past year and a half, we've said this many times, COVID has made us all reassess our priorities. They've packed in their jobs and started their own business, right? Whatever that may be. So, sole trader, self-employed, whatever you're doing, entrepreneur, whatever you're now doing. Advice for the self-employed, please, Tina, because I'm not going to be able to borrow any money. It's
okay. So generally speaking, if you're self-employed, the banks like to see evidence over time that whatever your business is doing, it can continue to generate that income. So typically that's a 2-year period. Some banks 18 months. Okay. Obviously COVID has thrown a spanner in the works, because that we may have had a 2020 that was unusual, or that could have been a 2019. And it's about trying to show those trends, and how the business would normally perform in a normal environment. What's become the challenge is that COVID has kind of become this new norm, and this open lockdown may be here for some time to come. If in that example where you said someone's gone from doing their day-to-day job and then decided to start up their own business, if it's a sort of business whereby you were previously working in a company, a large company, and then decided to go out on your own, and you're doing the same thing, but essentially have the skills, but now you might have a contract with a particular client. There are finance institutions that can accommodate that. It's not easy, but there is potentially a solution for that. If you were a copywriter, and then now you've decided to go out and become a cleaner, whatever the example is, then obviously you're going to need to get some runs on the board, not just from the bank's perspective, but if we go back to that fundamental of how am I going to pay my loan, how am I going to give the bank comfort and that certainty, there needs to be a bit of time and history to demonstrate that. So you're not then saying, well, actually, this didn't work out and now I can't afford to pay my loan. That's kind of the sort of the nutshells of it.
Yeah, which, I mean, again, like you say, the principles of how the bank's assessing you haven't really changed. They're assessing risk as they should. Okay. I've thought of one more question. Can I squeeze another one in? Super funds. How are we looking? Because I still get we get a lot of inquiries. We do purchase for a lot of clients who want to buy property within their self-managed super fund. And I feel that has gone through, lots of banks borrowing to two banks only lending to super funds. Now, is there more choice? How are the banks looking at super funds? And is there any, can you borrow money? Yeah.
You generally won't find a bank that's looking at super funds unless it's, potentially an exception for a private client that's, high net worth or something.
Yeah.
But generally speaking, finance providers really stepped up into that space. And, initially it was just your Liberty and your La Trobe and Think Tank. And then now, because there's a few more emerging in that market, there's been some more competition, which means downward pressure on rates.
That was kind of the vibe I was getting. Yeah.
In addition, some of those providers are getting pretty cluey and seeing the ability to do a fast, because they're not banks, they're not under the same kind of compliance and restrictions. So, a comfortable level of risk might be, you've got a loan in place for 2 years with us, St. George, your rate is up here, we can refinance it to here, and we can do a fast track type refinance with minimal legal fees and minimal So that's a new space that we're seeing a lot more of. So if you are stuck in one of those type of loans, it's probably worth reviewing.
I was looking at refinance. Actually, nice segue there. Looking at figures, I think for a video I did a couple of weeks ago, that it's the amount of refinances that have been happening over the past year and a half is extraordinary. Is
phenomenal.
Extraordinary.
Yeah. And there's refinance rebates that make it make more sense to pay those exit fees.
But again, we do want to urge caution, don't we? Don't just leap to whoever's giving you the biggest cash incentive to refinance.
Absolutely.
First, right?
You have to always do the numbers.
Yes.
And first point of call should always be to your existing bank to see what rates they can give you. Most definitely. Put significant pressure on them to reduce those rates.
Which, as we both know, I did myself very successfully about 2 days ago. Picked up the phone.
Exactly. Threatened to leave. Because for the banks to rewrite those loans, it costs them money. So more often than not, it just makes sense to keep that on their books. And, if you do then go down the path of, the rate they gave you is not competitive, and then you do the numbers and you work out, even after paying exit fees and so forth, and moving to another bank, that it still makes sense and you're going to have money back in your pocket. And then you go through that process, sign up loan documents, send through discharges, and then your bank says to you, oh, actually, now we'll match it. Just remember the time that you put into doing that and the fact that the bank said no the first time, and go through with the process and tell them where to go is my advice to you, purely because they really could have saved everybody that time and just matched their new customer rates right up front. So that is my advice to you. Go through that process.
I know. You've gone through all that hassle. Thank you, Tina. It's brilliant. Have you any sort of other, I know we've talked about a lot here, guys, so any other sort of bits of advice or things we could and should be doing, just financial health checks, or just to
look, I think I think lending parameters at the moment are very generous because of the assessment rates and the low interest rate environment. So if you're looking to get into the market, now is a good time in that regard. If we do start to see assessment rates move up and debt to income ratio restrictions further, which is basically how much you can borrow as a multiple of your income, if we start to see those go up, then that's going to have downward impact on how much you can borrow. So now is a good time to try and get into the market. Always be cautious of borrowing where you feel comfortable with rates being so low. Don't ever just look at your actual rate. Make sure you load 2-3% and onto that rate, and make sure you can afford that.
Yeah.
Because, you know, we've been around long enough, rates aren't always going to be this low.
Yes, that's right. Absolutely. Very important. All right, love. Thank you so much, Tina.
No, my pleasure.
Really
Lovely to see you,
appreciate it.
Kate.
And
hopefully
you.
we'll be seeing you in a restaurant or a
I
bar or
know,
something soon.
soon for our favorite sushi bar. Yes, let's try and do this again soon and give everyone an update on what's going on. But I think, as I'd say, I've said it for years, I'll continue to say it, it's really important that you go to see someone like Tina, a mortgage broker who has experience, not just your bank, but can offer you broad range of advice, broad range of lenders, doesn't shoehorn you, will look at your situation holistically, give you advice before you do anything. It's critical. So there we go. Hammered that point home enough, I think. Yeah, so we will see you soon.
Okay. Thanks, Kate. Bye.
I hope that you found all that useful, everyone. I always love a good chat with Tina. She is so knowledgeable. I will talk with Tina again soon so that you are getting all the latest property finance news. It is really important to keep up to date with how the banks are going to look at you and assess you. Please don't forget to just subscribe to the channel and hit the like button for me, and I will see you again really soon. Bye.